The Aquest Podcast, Funds Industry Conversations.
Hello podcast listeners and welcome to episode 4 of the autumn-winter season 2025 of the Aquest Podcast with me, Lawlor. If you're new to the Aquest Podcast, do hit like and subscribe and feel free to share with your friends too. I'm joined by my regular co-host, Dáire Lawlor, and in this episode we tackle the frequently asked questions we've received over the years on the topic of exchange-traded funds or ETFs. Now both myself and Dáire have worked in various guises on ETFs for many years, so it's a topic that is close to our hearts and one where we've received any amount of questions over the years. So for this episode, we picked out those that we think are probably most relevant or most frequently asked. They're really around some of the basics. So what are ETFs? Why are they so popular these days? Why is Ireland such a popular choice for domiciling and setting up your ETFs? What challenges are there for Ireland to maintain that position? And also, as we think a little bit more on the technical side, are ETFs something that could cause financial stability issues? So lots of ground to cover, but a very interesting topic. As I said, loads of people talking about ETFs these days. So with that, let's get on with the show.
The Aquest Podcast, Funds Industry Conversations.
Dáire, welcome back. Episode 4.
It's lovely to be here, Danny.
Fed and watered this time.
The pastries were a vast improvement on last week's catering, I'm pleased to report.
Well, I'm glad to hear it. And I'm going to ask for my payment, which is this intro music.
Ah, yes, indeed. It's the maestros are working on it.
Sounds like a lie.
It'll be. It's been kind of busy since I've seen you last. I've been in the back of a plane and all over the place, and between one thing and the other, I've only managed to hum the tune to myself, but it hasn't been rendered any more concrete than that. And I won't ruin your surprise by humming it here and now.
Well, let's have it by episode 6.
Sounds like a plan.
Okay.
Yes, boss.
Okay. This episode we're going to chat about ETFs. Before we do, just kind of a quick catch up over the last couple of weeks. We both were at a State Street event.
Yes, we were indeed.
Very nice event in
It was
Shelburne.
very good indeed. Martin Wolf scared the bejesus out of us at the end.
Yeah.
The slides came out yesterday. I don't know if you saw that.
Oh, I didn't look at them. Yeah,
it was a very interesting and informative event with a little bit of something for everyone in it, between the regulatory reviews and the discussions around tokenization, what have you. And then, as I say, I can't remember the exact title of his talk, but it was something around uncertain times.
Wow.
And he certainly made a compelling argument, while not at any point mentioning the rather large country to the east of us that is causing us some problems on and off the moment. He nonetheless managed to paint a fairly bleak view of where geopolitical is going. But interestingly, was very positive about, he picked out Switzerland, Ireland, and I think Denmark as being examples of small, open economies that are managing to run their economies not on a deficit basis and to be successfully manifesting growth in uncertain times. So, there are scintillas of hope hither and thither on it all.
The thing that keeps me from losing my mind when we talk about the current geopolitical state of the world.
Yeah.
There's an old saying, the present age is never the golden age.
Correct.
And I remember hearing recently a study, and I was saying about how great the 90s were. The 90s were the time that, was the best in the world. And I think, I'm pretty sure in the 90s people didn't go around thinking this was the best time in the world.
I seem to remember going to an awful lot of emigration wakes.
Yes.
At the time.
So you can reflect back and say the 90s was great, but you do that from 30 years down the road.
Yeah.
And in 30 years' time, to be going back saying, oh God, 2025, wonderful year.
Yeah, exactly. I think we all managed to eat dinner last night and there's a roof over our heads, so we'll be grateful for what we have.
Indeed. It does feel like the Christmas circuit has started.
Without a doubt. And then last week it was the Irish Funds UK Symposium held in Houndsditch in London and very well attended.
Great and the good, I imagine.
Great and the good of the Irish funds industry and their clients, and some very interesting speakers there as well. Simon Coveney among them.
Really?
Talking about making the case for capital investment in defence and how defence stocks, while would have been previously on the naughty chair from the perspective of sustainability and what have you, he was effectively arguing the case that if we want societal sustainability, the ability to defend oneself is fundamental in an uncertain world, and that there's a strong case for indigenous European capital creating an indigenous European defence industry, which was a very interesting angle.
So does that mean that defence stocks and ammunitions and all that are no longer not ESG?
Well, I would love to know what the carbon footprint of what's going on in the Ukraine is. I have a feeling washing our yogurt cartons is not going to atone for that particular carnage, and not wishing to make light of what's a very serious situation. But yeah, well, I mean, the case was being made that Europe as a geopolitical entity has typically looked to the East for our energy and the West for our defence, and neither of those are necessarily sustainable positions anymore.
Interesting.
So yeah, it was very interesting.
So one of the speakers at the State Street event was from the European Commission for the Financial Services. So the European Commission, and was talking about simplification.
Yeah.
And I'm maybe I'm old and jaded, right? But I find that I'd like to see the proof of the pudding, because on the one hand it's simplification, but the other hand it's not reducing standards. And they talk about it, and I'd like to see how that is to be achieved, because it feels like in reality they kick against each other a bit.
Yeah.
But on the same day as the Irish Funds Conference, the Commission did publish their proposal for the revision to the Sustainable Finance Disclosures Regulation, SFDR.
May I just congratulate you on your segue there? Very good.
Well, that's like I've done it before, right? But so they published SFDR, and in fairness, it is quite different. I didn't think they would scrap Article 8 and 9. I thought that they had imposed such a cost on the industry to implement 8 and 9, even though it wasn't very well developed. It felt like a system, a regime that was put in place because of a pressing demand without really thinking about how it was going to work. And then when they thought about how it was going to work, having made everybody incur the cost, they decided it doesn't work. So let's revisit it. And actually, they do have armaments in there. But not all armaments. I have to get the phrase.
There's a lot of conditionality out there. But it was interesting that I personally would have started from a position of extreme skepticism.
We're hanging around too much, Dáire. We're hanging around too much.
Yeah, too much the hippie thing on the armaments. But interestingly, and to segue again, the area of thematic ETFs and exchange traded funds is an area where one can see inflows into defence stocks it's at a slightly different level. It's around creating thematic defence stocks for investment, because clearly in an unstable world, countries need to invest in their defence, so therefore the firms that provide the equipment to do so are going to do well. So there's been quite a lot of inflows into the defence stocks over the past time.
Well, we're going to pick up an ETFs. On the SFDR proposal, maybe it is possible that either there'll be simplification and maintenance of standards, or simplification, and if the standards come back a little bit, maybe that's okay too. It is only the start of that process. So let's see, after it gets through trilogues with the politicians, how it comes out the other side. But I guess it's not a bad start.
There are two fundamentals around ESG that remain. I know there are political quarters that, for various reasons, don't want to be associated with it, what have you, but it is a fundamental risk management question. If you're in the insurance business, then rising water levels, whatever the reason for them, are an impact on your business. If you're lending money to people who have non-sustainable homes, those homes are of less value on your balance sheet than sustainable ones, and that has a reflection on the interest rates that you charge. So there is an element of that the market and the ancient principles of fear and greed will continue to drive a risk management agenda that includes climate risk and coming up with adequate responses to that, So
market discipline.
So obviously guardrails are very important. There is a risk management argument behind an awful lot of this that goes beyond a concept of you being a green or a tree hugger or a petrochemicals guy or what have you. So it'll be interesting to see how it all plays out.
It will, but certainly money talks. And if it is an opportunity to generate electricity through harnessing solar power or wind power or wave power or whatever,
do it.
Why not? If you can turn a profit, and if it happens to save the world, all the better.
As a side effect.
So ETFs, exchange traded funds.
Indeed.
We're going to chat through some of the frequently asked questions that come across our desks in day-to-day life and have done over the last years and years, because it is an incredibly well-established and popular product, really, or structure more than product. So let's delve into that. First question is, what are ETFs and why is everyone talking about them? I'm going to jump in there first.
Go for it.
Let you for it. So ETFs, exchange traded funds, are two things basically. They are investment funds, so they are opportunities to pool your capital with other like-minded investors, appoint an expert to manage that money for you, and hopefully when you exit with more than you went in with, an investment fund. What's different about it is that it's exchange traded, which means that you can buy and sell your shares in these funds through your broker on the exchange. Now, typically when you buy and sell your shares in a fund, you deal directly with the fund through their fund administrator or transfer agent. But for these types of products, they trade just like you buying your stocks and shares in Google or Meta or whatever your preference is. You go to your broker and you buy them on the exchange. Now, that creates issue or challenges around how they operate that you don't necessarily need to know all the ins and outs of, but just at a high level, the difference really is that when you deal with the fund, the price that you pay and the price that you get back when you sell is what the underlying value of that fund is divided by the number of shares in issue.
Correct.
So that's how you determine how much you're going to get. It's what the fund is worth based on the assets that it has. When you deal on the exchange, you get the price that somebody is willing to buy or sell the share from you or to you. So they're slightly different things. And the challenge with ETFs then, from an operational perspective, is to try and keep the market price on the exchange very close to the price that the shares are actually worth on the primary market when you look at the assets of the fund. And that's where a lot of the genius is, the operational genius, because the actual funds themselves as a strategy, and we'll wrap up on this, they tend to be what are called passive funds or index tracking funds. So they tend to say, well, I'm going to track the S&P 500, which means I'm going to buy all of the stocks in the S&P 500 in the same weightings that they are in that index. So if Meta is 5%, I'm putting 5% in Meta. I don't take a value judgment on whether Meta is a good stock or a bad stock, or it's going to go up or down. If it's 5%, it's 5%. And then as the S&P 500 moves, then the value of the fund should move in the same way because it's made up of the same stocks and shares. So they're passive index tracking funds. They don't require a lot of genius from an investment perspective to run them, because you're not making value judgments on the underlying stocks. You're not deciding whether you think Meta is good or bad. You're simply buying whatever is in the index. That bit is pretty straightforward, but it's the bit where they operate the fund in a way that keeps the price on the primary market based on the value of the assets that the fund holds close to the secondary market, which is the value that people are willing to buy and sell the shares on the exchange for. Yeah. That's an exchange traded fund.
Yeah.
Why are they so popular?
Fees are lower, number one. So they tend to amass large amounts of investment. And while the mechanisms are complex, once in place, there's an element of rinse and repeat operationally in terms of how they work. Immensely complex operational pieces around it. So if you're holding 500 stocks in an S&P 500 with 500 different income events, corporate actions, index rebalancing, etc., within your mix, and you're looking to assure that the secondary market doesn't fall victim to arbitrage, with too much of a divergence between the value of the underlying baskets, the cash and expected income not being entirely accurately reflected in the secondary market price. There are firms that have teams of people devoted to identifying those glimpses of daylight and making, well, quite legitimately making money out of that. But the divergence cannot get too great, and that's why the market makers and the liquidity providers and authorized participants are such an important part of that whole ecosystem.
Very important. But from an investor's perspective, though, you're right, very cheap.
Yeah.
Because running the fund from an investment management perspective doesn't require an awful lot of genius, right? You're just buying, you're passively buying whatever's in the index. They don't tend to have...
source is in the index rather than in the portfolio management. Well, I think our portfolio managers will beg to differ, but the bar is
We're
lower.
Underselling them.
The bar is lower.
But generally, if you have a stock picker who's bringing their genius, they charge you more in a management fee than somebody who's simply following an index.
Correct.
So they do have low fees, but they're quite easy to understand. I buy this stock, and instead of buying and being exposed to the ups and downs of one share,
I'm buying
I've got 500 or FTSE 100 or whatever it is. I'm buying a whole index worth of, a whole market worth of stocks and shares in one share.
Yeah.
And so I've diversified my risk. And over time, with low fees, the expectation is that it will move upwards as markets tend to do. Give them long enough.
Yeah, and it's understandable. The FTSE index or the S&P or the Euro stocks. They're on the you can see what's happening there. That has exploded out. So my first experience in exchange traded fund was back in 2010 when I joined State Street, and they were onboarding at the time the iShares business, which at the time I think was 3 umbrellas of about 90 funds. An umbrella is sort of the PLC company within which sub funds live, and they had a variety of fixed income, typically in those days either fixed income or equity fund indices that they were tracking across 90 different ones. That's now, I don't know, BlackRock are out to 6 or 7 umbrellas at this stage, and
it's phenomenally successful.
Huge diversity of. So there's massive diversity within it. So if you want to go into clean water, there are a family of ETFs that invest in indices that have identified firms on a global basis that look at clean water. If you want to expose yourself to emerging markets, there are a raft of products that can be done there. If you're looking for fixed income based on medium capitalized firms with riskier bonds or whatever, they're all out there. So there's huge diversity in what's available in that passive space before we even get involved in what's going on with the
I suppose the original ETFs back in the day, so they've been around since very late 90s, early 2000s, and the original ones were tracking the big well-known indices. And
the granddaddy of them all was the Spider, which is an S&P 500 tracker launched by State Street Global Global
Advisors.
Yeah.
And then it went from, they're now covered, so it went to not just equity indices, but bond indices, and then not just in more developed markets, but now let's give you exposure, let you track an index in China or in India or wherever, and then it grows from there into thematic. So you're interested in armaments and munitions, or you're interested in clean water, or you're interested in tech startups. Well, probably a bad example, maybe bigger tech companies. So very wide coverage of themes, very wide coverage of indices, and a very easy way then to get exposure, hence, and at very cheap rates, hence they've become exceptionally popular amongst investors and then amongst providers
and
to satisfy that demand.
They're understandable. So if you're on Revolut now, you can buy whatever, an interest in an ETF and allow that to track, and people get it. They're easily marketed. Now there are headwinds around them, from a taxation perspective. And interestingly, Ireland is, and I think the Irish Funds Industry Association recently published some figures. We've got about 78% of European exchange traded funds are domiciled here in Ireland. They're worth, about 1.8, 1.9 trillion euro are domiciled here on the balance sheet of Ireland. Managing all of that represents not quite a third, but a big chunk of the Irish funds industry is around exchange traded funds. So they're a very significant marketplace, and one of the reasons why Ireland has been so successful is around a taxation treaty that we have regarding withholding tax for US investments in US equities. So income from US equities is charged at a reduced rate of tax for in Irish domiciled funds, and that makes them globally very attractive for investors because they become tax efficient. That's not the case for an Irish retail investor. And there was some excitement, if such a word is not too overstated, in ETF circles that perhaps in the most recent budget that the Department of Finance might look at their treatment of private and retail investors in Ireland's taxation situation vis-a-vis exchange-traded funds. That didn't happen, but it was noted in the budget that it needs to, and that the brains trust in there are figuring out how precisely to untangle that Gordian knot. But they are, from at a big picture level, they're inexpensive to invest in. They offer you a range of exposures at relatively low cost and mental exercise, other than having to pick from the vast array that are out there. And at a thematic level, they're easily understood.
And so then the next question, when you've kind of preempted a little bit there, is why Ireland is so popular as a domicile, a place where ETFs are set up. And you're right. So the guts of 80% of European ETFs are located in Ireland, and worldwide Ireland is second only to the US in terms of being a domicile where most ETFs are. And it makes up about a third of Irish fund assets are in ETFs. So it's an enormously large part of our industry and an enormously successful one. Why has it been successful? Well, there is obviously the tax piece.
There are a couple of other factors though. The UCITS brand has become hugely successful, and while we spend a lot of time beating ourselves up here in Europe, if I may return to one of my favourite themes, about being over-regulated and over-cautious and what have you, nonetheless, the UCITS brand has become recognised globally as the gold standard for investor protection, transparency, and all the good stuff that you want to know about if you're putting money into something, that the governance structures associated with UCITS and ETFs are typically UCITS funds, with some exceptions depending on what they're looking to invest in at the moment. So you've got that UCITS brand, and then I think the third thing that you have that can't be underestimated is the depth of knowledge and experience operationally that has grown in Ireland as a consequence of the inflows that came through tax advantage. We have built what can only be described as a global centre of excellence for the administration, the front office, middle office, back office, infrastructural approaches to the administration and management and support, marketing and distribution of exchange-traded funds.
And so I mentioned that they're quite easy to understand from an investor perspective and quite easy to run from a portfolio management perspective in the sense that they're passive. They are quite complicated to run from an operational perspective.
Very much so.
And I think because Ireland has been there from pretty much the start, we've built up that understanding and expertise and knowledge and how to do this and do it very well. And that's a lot of the reason why we have such a large ETF industry is we got in there early, we grasped the opportunity, we learned what we needed to learn, and we've continued to learn. We have a regulator who understands ETFs and is interested in understanding more as they develop and adequately and properly regulating that. But ultimately, getting in there first is a really good example of how getting in there first is important, because it has given us a huge head start on other jurisdictions that others have, I guess, struggled to catch up with us on. You can see it from the numbers. So it's a real example of when it comes to new, and we think about MICA and private equity and private credit, they're kind of opportunities that maybe I don't feel we've grasped as well as we could have done. And ETFs is the reason why, is the example of why you want to grasp these opportunities, because you get yourself in early and embed that expertise and get that reputation.
And we've grown.
And it gravitates to you.
Our expertise has grown with the marketplace, and I think it oughtn't to be understated too that it might be overstating it to say digitally native, but as the funds were developing, so were the technologies around the administration of funds. So there has been a more technological. The reason I got involved with exchange traded funds back in 2010 was because of my IT background and because I was used to systems integration, because there are so many moving parts in an exchange traded fund. Technology is very necessary to help. So some of the some of the manual workarounds that one might get away with in a hedge fund world or what have you, you just can't do because the level of scale and the level of complexity in terms of the portfolios that are being managed
So
tends to be challenging without those technologies.
So as we sit here and pat ourselves in the back for our wonderful ETF industry, what are the challenges then? What are the things that could go wrong, or where could we take our eye off the ball and then reflect on this a few years down the tracks and say, gosh, we made a mess of that?
I think the expertise is the expertise. So we have the operation expertise, we have the depth of experience that exists here to our advantage. And I think, and one other thing that I could add to it is that we've also been very good at coping with and understanding the European marketplace is very distinct from the US marketplace in a number of ways, not least amongst them being in the absolute lack of homogeneity in the marketplace, in that we've got a very fragmented marketplace. There's, I think, some 52 exchanges upon which a secondary market deal could feasibly be done with an exchange traded fund, as opposed to everything going through DTCC in the United States. So while the United States is a vast market in terms of numbers of people, the infrastructure is actually much less complex. The products that have been created, the UCITS products that have been created in the European context are, by their very nature, have additional layers of complexity. So there are a couple of things that are outside of our control, where the uniqueness of our offering may be under attack. One is the big, bad, beautiful bill, or whatever it was called in the States. There was a point in that, in the evolution of that bill, where that withholding tax advantage came under scrutiny. It has survived that, however, with portents of it being examined down the line. So the taxation opportunity may be diluted at some point in the past. We have very little control over that, other than our capacity to lobby. Will a bowl of shamrock every St. Patrick's Day protect us from a change in the withholding tax regime on our exchange traded funds? Remains to be seen.
Maybe, hopefully.
Having said that, I think money talks, and a huge amount of the capital that's being invested in those funds that's taking advantage of those tax advantages is US institutional offshore money. So, there will be a powerful lobby for the maintenance of those constructs from within the US outside of our own. But I think it would be fair to say we need to file that away under an uncontrollable. Our skill set is something that we have to aggressively continue to develop and deliver on. And I think, in fairness to the industry as a whole, we're quite good at doing that. I think the simplification agenda in Europe may lower some of the barriers, some of the levels of expertise that we currently have available to us may cease to be relevant.
Possibly.
There was a point in time in Formula One racing when carburetor experts were like gold dust, and then fuel injection came along. So there's those challenges there as well.
I think from my perspective, I think it's important that we don't get complacent and think that this could never happen, that other jurisdictions could catch up. So that's really important, that we always try to improve what we do and how we do it, and don't assume others can't do that, because you can be absolutely guaranteed other jurisdictions will look at what we have and they say, I'd like some of those players in my plate.
And the central bank, in fairness to them, after much, they have looked at things like the fund naming issue and in and around the on and off exchange share class questions have been, addressed to the general satisfaction of industry. And I think the dialogue with the regulator has been generally fruitful, and I think we're fortunate again that our regulator has an in-depth understanding of this industry space too. But to your point, complacency is definitely not an option, and it remains to be seen. We hear guys like Larry Fink and Diamond talking about tokenization. So if you have a world where all the securities that are held in the S&P 500 are available in electronic 24/7 tradable format, there will be seismic changes in how those are administered and the level of expertise that's required and how much of it can be done programmatically, etc. in the future. So automation is always going to be a feature of the business and has been embraced very successfully here in Ireland. But, there are opportunities and risks associated with what comes our way.
And if anybody's interested in knowing more about tokenization of funds, they can refer to our last episode.
Correct.
Episode 3.
I don't tend to go down that rabbit hole right here and now.
Let's not do that again.
But I'm suppose, saying the technology thing has two sides to it.
So in terms then of the continued growth of the ETF structure, what's next? So we see a lot of passive funds, we see a lot of indices and themes are being covered. We've heard about active ETFs for quite a while. The volume and size of active ETFs is still pretty modest. What's next for ETFs?
Interestingly, and I have to put my hand up here and say that among the many hats that I wear, one of them is that I represent a firm called ETF Book that provide ETF data to ETF data issuers, providers, brokers, purchasers, capital market desks, etc. And that's a hat that I wear. Interestingly, our founder was in New York City last week at the ETP Forum in New York.
Sounds like a blast.
And if you're so inclined, he had a ball. So while we were at the UK Symposium, he was there. And it's interesting, parenthetically, as a small startup that's been working in a very nerdy space, ETF Book have built a profile. And we've gone from 2 or 3 years ago, where it was all about trying to get people to know who our name was, to a point where there are people queuing at the booth, and our data is being used on the Irish Fund's website.
So give us some data there now. Give us some insights into what's coming down the track.
Active is where it's at. So Ireland, interestingly, has been winning the race in that. So there's a lot of hype around active. I know we were talking in the crypto world about how, there can be an awful lot of noise comes out of the machine, but maybe the machine isn't as big as everybody thinks it is. But active is definitely a very fast growing area. And this is the area where effectively the funds, or a portion of the funds, are being actively managed by a portfolio manager to seek alpha. In other words, to seek gains over and beyond what the index would be expected to
as opposed to the previous type of fund we talked about, the passive fund, where you're just going to simply follow an index. These are actual stock pickers that are actually running a strategy.
So a successful passive exchange traded fund tracks directly to the index. The index goes up, the fund price goes up, but the index goes down, the fund price goes down. In active, the objective of the exercise is to make a little bit more. And if it goes down, maybe not go down, or not go down as much. And if it goes up, to maybe go up more.
So we've heard about active ETFs for a while. I said the amount of them is still modest. What is it that's going to trigger this actual shift into active ETFs?
I think what's happening is that, certainly the feedback that I got from the guys who were over at New York City was that every mutual fund provider, and the mutual fund is the bedrock of the US 401k world, that they're all looking to launch exchange traded product because they see broader distribution channels, because they see an increased leaning of particularly in the US, the retail market are very, very interested in buying more of these things. So they want to bring their products to those distribution channels, and they're looking to expand their footprint outside of the US. So there's a big stampede that. So at the moment, Ireland is the domicile for 96% of all the active funds.
So one thing that has changed recently as well was that there was a rule with ETFs that every day you had to disclose everything that was in the ETF, which if you were tracking an index wasn't such a problem because everybody knows what's in the index anyway. If you were an active fund with the secret sauce and this genius picking stocks, you didn't necessarily want to tell the world every day what genius activity you've been up to. And that has changed. There's semi-transparency now, so you don't have to disclose everything all the time.
Yeah.
And that should be a trigger for more active ETFs as well.
Yeah, absolutely. And there's just a huge interest in taking it there. And it also means that more esoteric products can be, so there's collateral loan obligation type vehicles. There are various leverage models that are being experimented with. So there's a lot more, more latitude for creativity in what's offered to the marketplace. Now, creativity and savings and investments don't necessarily always go hand in hand. So there's a need for appropriate scrutiny and what have you to be in place. But I think there's a combination of, and we were talking about financial literacy earlier on, but I think there's a combination of people like my kids know what an ETF is. They're seeing it in their payment apps, or if they're fluting around with crypto. You know, if you go onto eToro or one of these sites, they can offer you exposure to crypto, but they can also offer you exposure through ETF wrappers. To offer. So they're becoming part of the vernacular of the next wave of investors.
Yeah, and if the capital and investment union, the savings and investment union does really take off and does really get those savings out of deposit accounts and into the marketplace, aided by financial literacy and ideally tax changes, then that's a huge opportunity for ETFs if they're, because of how they're set up. If you have retail investors more actively looking to invest and they're available on their banking app or their preferred broker app on their phone, that's another potential huge driver for active ETFs.
And then when you look at the existing distribution channels for ETFs and you look at places like Latin America or the APAC regions, both of which put great faith in that UCITS brand that we were talking about earlier, and both of which are burgeoning, there's an emerging wealth that's seeking places, safe havens for investment. It's not only Europe, it's not only European money that's being pursued by exchange traded funds that are launched in an Irish offshore context. So it's an interesting time.
So with all that size in mind, all that growth in mind, it's a rather technical question. It doesn't come up that often, but it has come up. Do ETFs pose risks to financial stability? Now, sorry, before you jump in, when I think about financial stability, I guess I'm thinking about the possibility of contagion particularly. So if one money market fund or one real estate fund or one bond fund or one ETF had issues around their ability to repay their investors or something along those lines, is it possible that fund seizing up would cause other funds of a similar nature to seize up, and next thing you know, you get this contagion effect into the wider market?
Yeah.
For ETFs, well, I'm going to ask you first.
Well, I suppose the easiest way to answer it is that there have been a number of stress tests. It would certainly be the case that probably for longer, but I was aware of it from sort of, the mid 2015, 2016, that kind of area, that there was big scrutiny. The Financial Stability Board, BIS, and the various regulatory authorities were all a little bit concerned around this shadow banking concept, and they were looking at just the sheer scale of securities that were being held in these vehicles. Like, some of them are absolutely enormous. So I think you did a figure, what do we say, 21% of the S&P 500 stock is owned by passive ETFs. So they do have huge...
Yeah, their size alone,
because
they are so big, does merit and cause them to get attention. Yeah, absolutely.
Having said that, I think, there have been a number of fairly serious market shocks over the last few years. So if we look at Brexit, if we look at the beginning of the Ukraine war, if we look at Liz Truss's fever dream, there have been a number of fairly serious market adjustment events, and the ETFs have come through those unscathed. The diversity of what's held in them, I think, is a strength, as well as while the amount of dollar value that these things hold is enormous, the diversity in which it's held and the diversity of the shareholding holding them probably gives them some strength. They're certainly subject to significant scrutiny.
Absolutely.
And as recently as, this time last year, the Central Bank of Ireland issued a Dear CEO letter, laid out in very clear terms what they expected from the liquidity providers and market makers, and what they expected from the management companies in terms of their oversight on that, to make sure that spreads remain within appropriate.
They have got, like, ETFs have got a lot of scrutiny from all sorts of regulators domestically, from the central bank and from the IOSCO and from the FSB, the Financial Stability Board. So they have got a lot of attention, and the result of that work hasn't been to amplify concern around financial stability, but it has been around close monitoring of some of the pipework here around the market makers and the authorized participants to make sure that the firms running these ETFs understand what those market makers and APs, authorized participants, will and will not do. So financial stability risk, no. Don't think so.
Wouldn't say no, but not elevated. Let's put it that
way. I still would rather not see an ETF have serious issues and fail, because I do think then...
It's to date, touch wood, really, I can't think of an example. I'm sure there must be, but...
I think there are, but fairly niche product, and I think probably the risk is that as ETFs maybe dip more into more niche areas and invest or run strategies where the investments that they hold are more esoteric and maybe not as liquid as a stock that's in the S&P 500, that could pose challenges.
Yeah, but that idea that kind of the wrapper providing liquidity is one that definitely requires more probing. And it's interesting, at one level you've got huge amounts of assets piling into specific fund, such as the iShares S&Ps or what have you. But you now have this plethora of smaller players manifesting themselves in the marketplace. You've got the exchange traded note marketplace then looking at crypto baskets and what have you. So you've got lots of diversity, lots of healthy innovation and what have you in relatively small funds. And I mean, even if we look at the figures for the alternatives, 85 billion, 85 billion out of a 1.8 trillion market is, a relatively, it's a small number right now with those actives. But there's a lot of diversity of activity in there. So you have these monoliths, and then you have these new smaller players, which is an interesting dynamic at the moment.
Yeah, and so to wrap up on this one, I'd say in terms of financial stability, it's quite a technical question. If I'm an investor and I invest into an ETF, am I likely to lose money because of something operational or because of the structure seizing up or not being able to repay or not being sufficiently liquid? Probably not.
Yes.
If I lose money or if I get back less than I put in, it's probably because the market has fallen as opposed to something operationally has fallen apart. Yeah. These things are very well scrutinized.
Yeah, and they're utterly transparent.
And they're good, actually. I have no vested interest in saying that other than I'm in the Irish funds industry, but they are very...
No, they're really efficient. Yeah, they're very really well very well organised. And if you have your cap markets piece right, spreads are very tight, fees are very low. Yeah. And
they're definitely, for any investor, they're definitely something that's worth considering.
Yeah.
They may or may not be for everybody, but they're definitely something that's, as a structure, a way of accessing the market, definitely something to think about.
No, very much so. I think the vote of the jury is that we're all for ETFs.
Thumbs up for ETFs, yes. And on that bombshell, as the great man says.
Predictable though it may be.
Exactly. We're going to wrap up this episode there. Hopefully that has covered a lot of the general types of frequently asked questions that certainly I get around ETFs and their increasing popularity. Thank you very much, Dáire.
Pleasure knows.
Go away, work on this theme tune. I'm very much looking forward to it. We're only a couple of episodes out now from number 6.
I'll have to bake the flapjacks for next week.
I think you will. Thanks very much for listening. We'll catch you in the next episode of the Aquest Podcast.
The Aquest Podcast. Funds Industry Conversations.